So investing can feel overwhelming. Markets go up and down, headlines come and go, and prediction seems to change almost every day. But when you cut through all of the noise and look at what the long-term research actually shows, only a few factors repeatedly stand out as the real drivers of investment returns. So in this video, I'm going to walk you through 5 research-backed drivers of investment returns. We'll look at what the data shows, how these patterns have appeared over long periods of time, and what that might mean when thinking about your own investment decisions. So let's get started. So the first factor we'll look at is asset allocation, essentially how a portfolio is divided between stocks, bonds, cash, and other asset classes. This is one of the most widely studied areas in long-term investing. Large-scale analysis of institutional portfolios have examined what actually causes returns to rise and fall over time. So when researchers looked at how these portfolios behaved across many years, a clear pattern emerged. The overall mix of assets, that is, how much was held in equities, bonds, and cash, explained most of the variation in long-term returns, whereas factors like picking individual stocks or trying to time the market had a much smaller influence in those studies. So to understand why the mix of assets makes such a noticeable difference, we could take a look at how major asset classes have performed over extended periods of time. So looking at these extensive periods, several historical patterns emerge. Firstly, equities show the highest long-term returns. Although stock markets have experienced periods of volatility in the short term, long-run datasets consistently show that equities have delivered the strongest compound growth across most markets. Secondly, bonds and real estate have produced moderate long-term returns. So government and investment-grade bonds have historically offered stability and income, but with lower growth rates compared to equities. And long-term real estate data, which combines rental income as well as price appreciation, sits between stocks and bonds. Meanwhile, gold has generally maintained its value and purchasing power relative to inflation. But when compared to equities and real estate, it hasn't really delivered the same level of long-term compounded growth. So these differences help explain why asset allocation shows up so often in long-term research. The mix of assets in a portfolio largely shapes the kind of outcomes it experiences over time. So portfolios with a higher allocation to equities have historically captured more long-term growth. Portfolios that lean towards bonds have tended to show greater stability and lower volatility. Meanwhile, portfolios with a meaningful gold exposure have generally emphasized preservation rather than long-term compounding. In other words, your long-term return pattern is closely tied with how you divide your investments across different asset classes. That's why asset allocations appear again and again in academic and industry studies as one of the most influential drivers of long-term investment outcomes. So another widely studied factor in long-term investment research is time in the market, essentially how long an investor stays invested. So these numbers really show how much the time horizon matters in investing. Over a single day, the market is basically unpredictable. It could swing either way, but once you take a look at a full year, the picture starts to settle with positive returns 75% of the time. Stretch that out to 10 years, it gets even more consistent at 95%. And in this data set, every rolling 20-year period showed a positive return on investment 100% of the time. What this shows is that the longer you stay invested, the more consistent and positive the outcomes will be, reinforcing the core idea behind a simple buy and hold strategy. There's also something in the research called the missing the best days effect. It basically asks, what if you're out of the market for just a handful of the best days? And when you look at the historical data, those few missed days can make a significant difference. For example, JP Morgan looked at a 20-year period in the US stock market and compared what happened in different scenarios. Someone who stayed fully invested during this period saw an annualized return of 8%. But if they just missed the 10 best days, that dropped to around 4%. Missing the 20 best days brought it down to roughly 1%, and missing the 30 best days resulted in a negative long-term return. And what's really surprising is when those huge up days happened. They weren't during calm markets or obvious recoveries. A lot of them showed up right in the middle of the chaos. So for example, in the 2008 financial crisis, several of the biggest one-day gains happened only weeks following the market bottom, right when investors felt the most uncertain. And in 2020, during the COVID crash, a few of the strongest days came the day after some of the worst declines. So researchers point out that big down days and big up days tend to be clustered together. They often happen back to back. And because of this clustering, it's almost impossible to predict them ahead of time. In the historical data, staying invested was the only way to consistently capture the biggest gains. Another factor that directly influences long-term investment outcomes are fees and costs. Even though they look small on paper, maybe 0.5% or 1% here and there, many large-scale fund analysis show that these charges add up significantly over long periods of time. Reviews of mutual fund data have found that ongoing fees like management charges, administrative cost, trading expenses have been some of the biggest contributors to the gap between what the fund earned and what investors actually kept. And this pattern is reinforced in Morningstar's research, where they consistently show that a fund's expense ratio is one of the strongest predictors of its future performance versus its peers. The logic is pretty straightforward. Lower fees means investors keep more of the return, while higher fees tend to reduce what investors receive. We see the same trend when active funds are compared with passive funds. Industry research shows that while some active managers do outperform the market on a gross return basis, once you factor in the fees and the costs, the majority of these active managers underperform the market over the long run. This difference between gross returns, that is before fees, and net returns, after fees, is one of the central ideas in long-term research. On a gross basis, active managers as a group tend to cluster towards the benchmark. But once fees are deducted, the average shifts down, making it statistically harder for most active funds to outperform the market over long periods. So to see how fees interact with compounding, let's take a look at a simple example. Imagine a one-time $100,000 investment held for 30 years, earning a standardized 7% annual return before fees. Here, all three investments earn the same market return before fees. The only difference is the annual cost. And over 3 decades, that difference becomes surprisingly large. In this example, the gap between a 0.1% fee and a 2% fee grows to more than $300,000, even though the underlying investment return is identical. So after 30 years, the highest fee option ends up with around 42% less compared to the lowest fee option. Ultimately, fees are one of the few variables that are completely transparent, easy to measure, and cumulative over time. These examples help show why fee levels have played a noticeable role in the net returns investors have received in long-term historical data. Another factor that consistently appears in long-term investment research is investor behavior. Essentially, how people respond to market ups and downs and how those decisions affect the returns they actually end up with. Many long-term studies compare the performance of a broad market index with the returns that everyday investors earned over the same period, and a clear pattern shows up. On average, investors tended to earn less than the market itself. And in most cases, that gap came down to timing behavior, putting money in after markets had already climbed or selling during periods of uncertainty. Morningstar's mind the gap analysis looked at how a fund performed versus the returns that the investors in the fund actually earned. In many cases, the investor returns were about 1 to 2 percentage points lower per year than the fund's own results. But the gap wasn't about the fund itself. It came down to the timing of deposits and withdrawal decisions from investors. Behavioral finance research helps explain why this pattern shows up consistently. So human tendencies play a big role. Overconfidence can lead investors to trade more often than they need to. Losses tend to feel more painful compared to gains, which could then make selling during a downturn seem safer in the moment. And recency bias can cause people to put too much weight on what just happened rather than looking at the bigger picture. While herding behavior can push investors into decisions they might not have made on their own. We could see these behaviors in real market events. During the 2008 financial crisis, and again during the COVID-19 period, many investors reduced their exposures to equities near market lows because the situation felt so uncertain. And when markets eventually recovered, those who had stepped out missed a portion of the rebound simply because they weren't fully invested during the recovery. Meanwhile, large institutions often show a different pattern. Research from Vanguard, JP Morgan, and BlackRock suggests that institutional investors tend to trade less frequently and react less to short-term market movements. And as a result, the gap between market returns and realized returns tend to be smaller for institutions compared to individual retail investors. And taken together, this body of research shows that the timing and sequence of decisions, that is when money is added, withdrawn, or moved, have played a meaningful role in the returns people actually end up with. Even when investors were in the same markets or using the same funds, these timing differences often led to very different long-term outcomes. The fifth factor we'll discuss is the pattern of contributions. That is, how much an investor puts in, when those contributions begin, and how long they have to compound. Unlike market performance, which is external and unpredictable, this is one of the areas investors have control over. So research from retirement modeling groups show that the timing and consistency of contributions make a noticeable difference to long-term outcomes. This effect is especially visible early in an investor's journey, when new contributions make up most of the portfolio's growth. To show how contribution timing interacts with compounding, let's take a look at a simple illustration. Here, all three investors in this example contribute the same total amount of $50,000, and we apply a 7% annual return for demonstration. The only thing that changes is when that contribution takes place and how long those contributions have to grow. Investor A starts at age 25 and contributes just over $100 a month for 40 years. Investor B starts later and invests the full $50,000 as a lump sum at age 45. Meanwhile, Investor C also begins at 45, but contributes around $200 a month for 20 years. Even though the total contribution is identical across all three investors, their outcomes at age 65 look very different. Investor A's early start means that each contribution has decades to grow, which is why the ending value is the highest out of the three. Investor B puts in the lump sum at 45, giving the full amount 20 years to compound. Meanwhile, Investor C also starts at 45, but contributes monthly over 20 years. But because many of those contributions only have a short time to grow, their ending value comes out as the lowest in this illustration. What these examples highlight is how long-term compounding interacts with time. All three investors put in the same amount of money and experience the same market return. The difference in their outcomes comes down entirely to how long each dollar remains invested. Investor A's contributions begin earlier, each installment compounds for longer, and even small monthly amounts accumulate meaningfully over many decades. Investors B and C contribute the same total amount, but because they start later in life, the compounding effect is smaller. Ultimately, contributions made earlier and left to grow for longer have a greater opportunity to compound. This helps explain why different people investing the same amount in the same market can end up with very different long-term results, simply because they invested at different points in their lives. So when we look across decades of research and long-term historical market data, these 5 areas consistently show up as meaningful influences on long-term investment outcomes. Asset allocation shapes the kind of returns that a portfolio has been exposed to. Time in the market determines how long those returns have had a chance to compound. Fees and costs affect how much of the gross returns investors actually keep. Behavior influences when money is added or withdrawn. And contribution patterns determine how much capital has participated in long-term growth. Each of these factors play a different role, and together they help show why people investing in the same markets can still end up with very different long-term outcomes. So, as you think about your own investing journey, this may be a good moment to reflect on which parts of your investing approach align with these long-term drivers. If you found this video useful, please like and subscribe for more insights into economics, investing, and global markets. Thank you for watching and have a wonderful day.